Hello, welcome back to WINFXTRADING YouTube channel, the only channel that has been optimized to make you rich trading the forex synthetic market. Just about 35 minutes, we will enter the Xmas 25th December. I wish all my subscribers happy Xmas and New Year in advance. So I'm going to actually bring in this topic. This is a kind of stuff that have made a lot of people lose money. Before I continue, if you haven't subscribed to WINFX Trading YouTube channel, do your best to subscribe. And if you have been losing money in the forex market, right now we have a just concluded promo. But if you still want to actually uh, make money in trading, you really need to DM me with a message. The message should be entitled, uh, uh, just give it 20% discount. Okay, so you will receive 20% discount on our VIP of your choice. Anyone you want to join, you receive 20% discount. But if you still want to lose money on your own, because the reason why you come to watch video about forex trading is because you don't know what you're doing, right? Yes, anything that pays is hard, and for you to succeed, you leverage the effort of others. Okay, so that's by the way. So the topic we're gonna discuss right here is polarity war in forex synthetic market. These are the hidden facts, one of the hidden facts that people don't know, especially uh beginner in the forex. Even the experts in the forex market, they don't know this. They keep losing money because of this. So um I'll go deep into the fundamental, or the I'll follow it intuitively so that you understand what this is all about before I go to the technical chart. What is polarity? That's the first thing. Polarity means the state of being consistent in a given direction. A market will have up direction and will have down direction. The upward movement, like towards the north, is what you can call the positive polarity, like towards the north or anything related to the north. North is northwest, but not south. No, just northeast, northwest. That positive polarity. So anything that related to the south, like southwest, southeast, or even the south, the true south, that are called the negative polarity. Now, these polarities at any instant, at any point in time, they exist into negative, positive, negative, positive. They must coexist per second. So that is where we talk about frequency in the forex market. So frequency become one of the key parameter in signal production. Okay. Now when we talk about frequency, we also need to bring the notion of force. I mean the resultant force. Because when you know the direction of the resultant force, you can predict the market accurately. If the resultant force is negative and you are buying, you are losing money. If it is positive and you are selling, you are losing money. Okay? So this topic is very, very crucial. When we bring forex market at a particular level, when you see price as a moving particle, having a certain level of energy, being a polarized uh, system, you will now be able to apply deep mathematical insight into the market analysis for you to actually succeed. Okay. So I'm going to go to technical chart to actually open your eyes further to see what I mean. Okay. You see, the only time frame, we can actually, uh, like the lowest time frame that we can use to study the polarity event in the market is 1 minute time frame. But that is not the only time frame available. Some charting platform like Trading View, they have these seconds. They have seconds as like 1 second. You can see chart that is reading in 1 second. Okay, that lies there. You can see 1 second time frame. So I will manage the 1 minute time frame to explain what I mean by uh frequency and polarity, and we will go to line chart because we can actually understand it better on a line chart. Okay, so when you look for line chart, now just look at the price as a point. Okay, the point price or price as a point have two state values separated with a infinite difference, which is the spread. So when you have a point here, it is acted upon by two forces, the buy force and the sell force. Each of these forces, one has like a finite value or a definite value, the other one have a definite value. That is the difference between the two values. The difference is called spread. But that are the state value of the price movement. Like they define price at a point. So the separation of buy and sell price matters a lot. The separation matters a lot because this separation affects your entries and the profitability of your trade. The bigger the spread, the more difficulty you will find to get a profit because the asset have to break that spread barrier before you start seeing profit. But that is, by the way, I will bring this topic, as we go on because it's necessary. So now, when you observe price at an instant, as I see it here, for this to be reasonable, you have to assume that the spread is zero, and therefore the red line and the blue line converges, right? So when they converge, what are you seeing per second? What are you seeing per second? You see that price go up, go down, go up, go down in a second. Watch, go down, go up. Are you seeing it? The up movement is called positive polarity. The downward movement is negative polarity. The rate at which the positive polarity creates and the negative polarity creates, the integral rate, the total rate is what constitutes the frequency. Like the rate per second, the rate of change of polarity to, like the rate of change from one polarity level to another polarity level is what we call frequency. So this frequency is a characteristic of volatility in the market. Like it is directly proportional to the volatility, or it predicts the volatility in the market. Okay. So when market move from point A, like from here to here, it does so with what we call drift, polarity drift. It does so with binary event consisting of positive and negative polarity. For price to move from one point to another point over a finite distance, it, it does so with positive and negative polarity. To every positive polarity, there are also negative polarity associated with it, and to every negative polarity, there are positive polarity associated with it. Then you will see this if you go to candlestick domain. Now, for price to flow from here to here, it will not do it on a straight line. Okay, if you go to minutes, seconds time frame, you will know that it will not do it on a straight line. So it's moving from here to here. You will notice that there will be combination of bearish and bullish candles while it is moving. Most time you will not see it in 1 minute time frame, but they do exist in the seconds. Okay, but where the market want to show it, you will see it. An example is price flowing from here to here. You notice that it does that with positive polarity and negative polarity at the same time. So it performs two movements. Are you seeing it? It performs two movements. In a line chart, you may not be able to notice it, but in a candlestick chart, you will notice it. Okay. But the theory here, one of the things you should understand is that to every polarity you are observing, there are still the opposite polarity there. At certain lower time frame, you will see it. Okay, so price move in binary polarity, in two polarities. If we view price as a point, then that point is a wave that you cannot, it will be hard to observe it as a single entity. If you are trying to measure it as a single entity, it will not work until you measure it as a binary entity. You are monitoring price and hoping that it will go up in 1 second time frame. Suddenly it goes down. It keep this it keep this like it keep let's call it going against your wish, because it will be hard to think both positive and negative at the same time. You just think one, but price think in the same, like the price think this, like price think both, like it think both positive and negative at the same time. Because you as a human, you even with the most powerful measuring instrument, it will be hard for you to observe price to move in one direction in a second. But price know that it moves in two directions in a second. So we can have nanoseconds or microseconds. The only way you can observe one single polarity on a price, or when you observe an asset as a particle driven entity, is when you are measuring it at nanoseconds. Because at nanoseconds you can easily observe a single polarity in the price movement. You actually understand what I'm saying when you monitor the price movement at tick level. If you monitor the price movement at tick level, I'm going to show you something on the derivative side so that you understand what I'm saying. Look at what is happening. This is a tick level of price movement. See that red ball? That is what we call particle. Easy. What we say is abstraction. Like, you have to apply abstraction for things to work in the forex market. We are trying to force out something from nothing. We are trying to predict. We are trying to forecast. You know, it is not easy, if not because it is money driven something. Is the hardest something to venture, but we are making it easy. We can't predict future with accuracy, but we make it easy. We make it work. That's why you need to either enroll for our courses or you subscribe to our VIP seminars. Okay? Just look on that red ball. Try to predict the polarity per tick, per nanosecond. You see, when you are doing rise and fall, when you come to rise and fall market, when you set the time to ticks, that's where we know who is who. You see, they even know that it is hard. At tick level, price is moving at speed of light, close to speed of light. But I cannot over exaggerate. It may not be speed of light, but let's say 30 to 50% of speed of light. Okay. Now, if you ask, let's take 5 ticks and let's put $1. Making it 5 tick is you are reducing the frequency. Let's make it 1 tick to show how accurate you can be. 1 tick. Okay. Because you have to predict this. And every polarity have a state characteristic. Like, let's call it, it have a kind of the period of time for which it will be stable, like stability behavior. Like, it should be stable. If it jump from one point to another, let's say from A to B, it should remain at B for a good period of time, whether in seconds or in some scale of seconds, whether micro or semi-micro or nanoseconds, or even up to 1 minute. Okay. Now, if you are studying price event with this concept, you will notice that you can be able to trade tick. Like, you can trade at tick level as a binary trader with deriv. Okay. So let's try something. Where the ball is, this is where the ball is. The main thing is to measure the frequency. This is, you need to understand the rate at which the ball will jump from one state to another state or level to another level. And then you need to understand the speed at which it can do that, and then the direction. Okay. Is it positive or negative direction? Okay. So you see, it is a hard something, because when you look on that rate, it is not actually stationary. It is moving at even the least measurable time. At atomic time level is moving. Okay. But to prove that market, when it move, it does not move in one direction. Like at micro time frame or nano time frame, it doesn't move in one direction. Then I can prove that by using 1 tick. If market make a state, this is up state and going down. Okay. Now, you see, it is hard. I predicted down, but it went down after I predicted it. So let me try again. Let it change state. Let it change state. Up, down. We lose again. Why? Why? Why do we lose? It's because the speed, that tell you the speed. Okay? The speed is very, very high. the tick we use may not be the actual, uh, cannot be the smallest time, may not be the smallest time that the price is obeying. Okay, but I want you to know that price move in binary or two polarities, positive, negative. Okay, if you view price as a point, that point at the same time or simultaneously, they have two directions, whether you like it or not. Because they have two directions, you will find it difficult to predict one direction with accuracy unless you want to predict both. Now, let me give you an instance. I'm going to rise and fall. You will see that one of the trades will enter. Rise, fall. What happened? One enter. Do you see it? I have proven to you that this point you are seeing here does not move in one direction at micro level. It's a wave. You won't understand. It's number. It's mathematical stuff. It's computer. The behavior is the electron that is pushing this chart. If the electricity goes off, you will not see the chart. So the price movement is directly proportional to the frequency of the computer that are, the servers, the electromagnetic frequencies or the telecom, frequencies that are making this thing to come to real. So when we talk about frequency, you have to take it as real. Okay, and most times they follow some astronomical uh, uh, events or behavior. Okay, you won't understand. That astronomical stuff is beyond this uh, you know video. But price, the forex market is designed to rotate or to mimic the cosmic um, event, which I cannot go deep. But if you give it time to go deep into the idea, you will notice that, you know, uh, how do you think that the synthetic market will run 247? There is a mathematical formula that actually predicts the price at it, like that output price at micro level, and it has been designed to be alive in infinity, subject to what we call seeding or random number generator. The random number generator is based on Earth rotation, and since the Earth can never die, the Earth cannot stop rotating. The planet can never stop, cannot be stationary to infinity. That is one of the secrets behind the synthetic market. Okay, so forex market the same. It's just that artificially we pause it, like they just shut down the server, and shutting down the server does not mean the mathematical formula that guide the outcome of the price is destroyed. No, it's still embedded in the software that controls the outcome of the price, the values that the asset will take. Okay, so this video is taking time, but at least you learn a good lesson about what I mean by polarity. So as a trader, you take this into note when you are doing your technical analysis. So when you run the integration, you know, of these polarities, you will see that at macro level they become paramount. Okay, let's monitor the market in 15 minutes time frame. That is macro level. You see that at macro level, like 15 minutes time frame or other higher time frame like 30 minutes time frame, you see that when price move, they don't move like a straight line. They create a positive polarity and a negative polarity. But then you will not visualize it as a simultaneous event because you are monitoring it at macro level. You will visualize it as separate events. So they happen separately. So with this, you shouldn't be rushing trade. You shouldn't be rushing trade. You know that two polarities, two directions must occur for you to actually make decision properly. Like for you to get the best. You can't tell me that price impulse like this and then retrace. Okay, price impulse like this and then you just want to enter this market maybe somewhere here. That is wrong. Immediately you enter here, you start retracing, and that will increase your anxiety. And possibly if you use small stop loss, you'll be triggered. But if you waited for this retrace, like this retest to this zone that was broken, you can easily lump your orders along this path. It's better to even trade along this path. Even if you enter here, you know that it is moving. Okay. Also, another instance, price break this level and start coming down. You want to enter this market here, not knowing that price does not move in one direction. The retracement will come and trigger your stop loss. Even though here the retracement seems not to happen, but it did happen here. What if you can't predict the suppression of a retracement? What if it continues to come and test this area? Your stop loss might have been triggered. But if you waited and this retest happened here and you confirm that it is cool, then you can enter here and buy the market. Okay. But we have late entry and early entry. All these can be issues. Early entry is good if you are a strong analyst, if you are good. Late entry is also good if you can position after a retracement has completed. But they have disadvantages. Late entry, if you are doing late entry, you might be entering a trend that have saturated, then you will lose. And for early entry, you might be entering a market that is still trending to a given direction, then you will still lose. So it is all about experience and technicality. So you need to join our VIP for you to change your life. It's not all about talking, doing videos. All this is to help you. Okay, it's hard to find people like us on YouTube. So if you manage to subscribe here, try to join VIP so that you test success, like you test money, you test what it is to make profit consistently, steadily. Not you make profit today, you lose tomorrow. No, steady. Okay, WINFX Trading is here for you. 2024, you should make this money. 2024, you should make this money. Thank you and bye for now.